This is a hypothetical scenario, but it is not unrealistic. Picture this. It is a morning in June 2026. Two people are watching the exact same news. Across every screen, red breaking alerts flash nonstop. The United States dollar is surging. Inflation warnings are back on the table. The central bank has called an emergency meeting. In a small apartment outside the city, a salaried worker named Michael sits frozen, phone in hand. His thumb hovers over the screen. His paycheck comes to mind. $4,000 a month. The number has not changed since last week, but suddenly it feels smaller, like it buys less food, less safety, less future. He opens a search bar, heart racing. Should I buy dollars now? Did I already miss it? What if it keeps going up? The questions pile up faster than answers. Fear arrives before understanding. At the same moment, in a quiet high-rise overlooking the city, another man is also watching the news. David is an asset owner. He is not watching television. He is reviewing a spreadsheet. 35% in United States dollars, 15% in gold, United States Treasury bonds, cash on the sidelines. His expression does not change. He checks off a box on a list, not because he just made a move, but because these positions were completed years earlier, when the dollar was still considered stable and boring. He switches tabs. Another headline appears. Housing inventory surges. Rental yields begin to soften. For most people, this headline means trouble. For him, it signals timing. He does not rely on gut feeling. He relies on numbers. He watches transaction volume. He watches forced selling. He watches whether panic listings peak and begin to dry up. He watches for signs that fear has exhausted itself. The market is speaking. He is listening. The average person sees news and feels anxiety. The wealthy see data and measure opportunity. Same headlines. Completely different realities. One person reacts late, paralyzed by fear, chasing information that has already played out. The other moved quietly long before the story reached the screen and is now simply waiting for confirmation. What separated their outcomes was not intelligence, not education, not luck. It was something invisible, the way their minds were structured. Wealth is not divided by income. It is divided by systems of thinking. When the same crisis hits, why does one person collapse while another rewrites their future? That is the question we are answering today. When currencies swing violently and inflation returns, how do the wealthy think? How do they prepare? How do they protect purchasing power and position themselves to win? Here is the core idea. Most people react to events after they happen. The wealthy design their lives around what is likely to happen next. That single difference explains almost everything. The wealthy do not bet on one outcome. They prepare for multiple scenarios at the same time. If markets rise, they know what to do. If markets fall, they know what to do. If everything becomes unstable, they know what to do. Now watch the typical pattern. Fear only begins after breaking news appears. Only then does inflation feel real. Only then does currency risk feel personal. That is when people open banking apps and rush to buy dollars. But by then, the move is already crowded. Days later, when volatility cools, losses appear. People blame timing. They blame themselves. This is not bad luck. It is predictable behavior. Now look at the opposite side. The wealthy move before the headlines exist. When the Federal Reserve signals tightening. When global capital quietly shifts back towards safety. When trade imbalances quietly grow in the background. The world still feels calm. But the structure is already changing. That is when dollar exposure begins to increase quietly. When the exchange rate feels stable, they accumulate slowly. As pressure builds, they increase exposure deliberately. By the time panic reaches the headlines, most of the work is already done. And when the dollar finally surges and everyone is talking about it, what do? Nothing. They do not chase. They do not panic. They do not celebrate. They wait. Because defense is already complete. Now they are waiting for opportunity. Why does this gap exist? Because most people focus on price, the wealthy focus on structure. Most people ask, how much is the dollar today? How much is housing today? How much is the market today? The wealthy ask different questions. Where is global liquidity flowing? How wide is the interest rate gap? Which assets are becoming forced sells? Who is being pushed out by leverage? They study the forces that create prices, not the prices themselves. Think of it like a hurricane. Most people react when the storm is already hitting. That is when they try to secure windows. The wealthy prepare when the forecast appears. They reinforce structures. They stock supplies. They position exits. Markets behave the same way. Crises never arrive without warning. They whisper before they scream. Small cracks appear long before collapse. The wealthy notice cracks. Most people hear the collapse. And time is the difference that compounds wealth. Here is another critical distinction. Most people see the dollar as a trade. Buy when it rises. Sell when it falls. The wealthy see the dollar as a system. For them, the dollar is insurance. And It is ammunition. When inflation rises, dollar exposure protects purchasing power. When markets stabilize, those dollars become capital used to acquire discounted assets. The dollar is not a profit tool. It is a survival tool. That is why the wealthy respect the dollar, but never worship it. No asset is perfect. Not even the world's reserve currency. Many people ask this question, what if the dollar eventually falls? The wealthy think differently. They do not ask which asset wins forever. They ask how assets protect each other over time. When the dollar rises, it protects value. When it stabilizes, domestic assets recover. This is not about guessing correctly. It is about staying alive financially, no matter what happens. True diversification is not about prediction. It is about resilience. The average person buys dollars after fear begins. The wealthy already hold them before fear exists. The average person tries to avoid loss during crisis. The wealthy prepare to capture opportunity. Now return to June 2026. The dollar surges. Michael's reality becomes uncomfortable fast. The dollars he bought late barely offset fees. But inflation hits harder. Coffee costs more. Lunch costs more. Everything costs more. Income stays the same. Life tightens. Fear becomes constant. David feels no urgency. His dollar exposure has already done its job. But he does not sell because the real opportunity has not arrived yet. He waits for forced selling, for panic, for assets priced for fear. When that moment comes, he will quietly convert dollars into ownership. This is the cycle. Prepare in calm, defend in shock, acquire in collapse. Most people live the opposite cycle. Spend in calm, panic in shock. Miss opportunity due to lack of liquidity. So the question becomes unavoidable. How do you move from one cycle to the other? That answer begins with 3 structural differences. And the first one is where almost everyone fails. The first structural difference is concentration versus preservation. Most people unknowingly place nearly everything into a single bucket. Their checking account, their savings account, their retirement account tied to one market, one currency, one system. It feels safe. Until it is not. Cash feels stable because the number does not change. But inflation does not attack numbers. It attacks purchasing power. Money left idle is like ice on a summer sidewalk. It looks solid, but it melts quietly. $4,000 in a bank account still says $4,000, but over time, it buys less food, less shelter, less freedom. The wealthy understand this early. They do not worship simplicity. They design balance. They build portfolios like counterweights. When one side falls, another rises. United States dollars, gold, government bonds, cash reserves, sometimes real assets, sometimes productive businesses, not because they know what will happen, but because they accept they do not. This humility is the foundation of real diversification. Most people ask, what will go up next? The wealthy ask, what protects me if I am wrong? That single shift changes everything. The second difference is endurance versus replacement. When crisis hits, most people shrink. They cut spending. They delay life. They hold their breath and hope the storm passes. They stop going out. They stop investing in themselves. They stop making decisions. They survive by freezing. The wealthy do the opposite. They do not freeze. They rotate. They cut what is decaying. They replace it with what will endure. They move variable debt into fixed structures. They exchange weakening cash positions into stronger currencies. They rotate out of stalled assets into defensive income-producing ones. This is not about lifestyle sacrifice. It is about structural replacement. Crisis is not a pause for them. It is a renovation. For the average person, crisis feels like suffocation. For the wealthy, it is rebalancing. The third and most misunderstood difference is how the dollar itself is viewed. Most people see the dollar as a trade. Buy low, sell high. They chase it emotionally. They fear it emotionally. The wealthy see the dollar as infrastructure. It is insurance when purchasing power is under attack. It is dry powder when fear creates discounts. When inflation accelerates, the dollar preserves value. When markets break, the dollar becomes leverage. It is the bridge between survival and opportunity. This is why the wealthy never ask whether the dollar will rise forever. They ask when the dollar does its job, what comes next. Now return once more to that night in June, 2026. 2 people, same news. One sits in a dark room, refreshing search results. Should I buy now? Is it too late? What if it gets worse? Regret mixes with fear. Every decision feels heavy. The other closes a laptop. Checklist complete. Dollar allocation complete. Gold allocation complete. Cash ready. His expression is calm. Not because he predicted the future, but because he prepared for uncertainty. So, let me ask you directly. Before watching this, where were you positioned? Were you reacting after the fact? Or were you already thinking structurally? This is not about becoming wealthy overnight. This is about never being trapped again. Wealth is not an accident. It is not talent. It is not timing. It is positioning. The world moves in cycles, but not everyone lands in the same place. Those who react late always feel unlucky. Those who prepare early always look calm. This video does not tell you what to buy tomorrow. It tells you where to stand when the next shock arrives. Because the future does not reward prediction. It rewards preparation. If you had never seen this perspective, how different would your next crisis look? Maybe the same fear, maybe the same late reaction, maybe the same missed opportunity. But now, something has shifted. You may not know every answer, but you now see where the divide begins. Not in assets, not in income, but in mindset. This channel exists for people who want to read signals before headlines. For people who want choice instead of panic. If this perspective resonated, leave your thoughts below. And if you want to continue learning how systems move before markets react, stay with us. Because the next crisis will not ask if you are ready, but your preparation will decide everything. The truth is, the next crisis will not announce itself politely. It will not wait for permission. It will not slow down because people feel unprepared. It will arrive quietly. Then suddenly, and when it does, the outcome will not depend on intelligence or effort or how hard you work. It will depend on where you were already standing. Most people believe wealth is built during good times. History shows the opposite. The greatest shifts in wealth happen during disorder, during confusion, during moments when most people freeze. That is when systems matter. That is when preparation reveals itself. You do not need to predict the future. You only need to stop being surprised by it. Because the real danger is not volatility. It is being forced to act when you have no options. Those who prepare early always look lucky. Those who react late always feel betrayed. But nothing about it is luck. It is structure. It is positioning. It is thinking one step before the crowd. The question is no longer whether another shock will come. History has already answered that. The only question is this: when it does, will you be searching for answers or calmly checking your list